because all of you have done EVA, right? Anybody who has not done EVA, let me know. Okay, I'll talk about the first assignment next week. So I hope many of you can turn up. I can give you an idea of what your first assignment is going to be. It's basically on embedded research. So that goes down on your EVA assignment that you did before. You're all aware of that, right? With the embedded research. So with your EVA assignment that you did last semester, we will follow through into this semester, but we will look at what we can use options to do with your previous EVA assignment. Okay, so I'll put up the assignment in a few days' time, and then I'll also talk about the assignment and get you through how to attend the assignment next week. So you will have something like 2-3 weeks to complete the assignment. It should be fairly easy for most of you if you have been able to follow the lectures so far. Okay. So first assignment will be on options, and your second assignment will be on futures, trading futures. Okay, so we talk about the second assignment after the semester. Is there any questions from last week? Anything that is not clear from last week's lecture that you want to clarify? No? All good? Okay, if not, then we... Oh, we talked about the proof now. Okay. Okay, so... Okay, so continuing from where we left off last week on dividends, I want to emphasize that with dividends, there are 2 time periods you need to be consciously aware of. Okay, and these 2 time periods are essentially one being the option expiration, the other one being the dividend payment date. Okay, so you must always account for 2 time periods. And also because there are 2 time periods, you find that it is easier for you to use a binomial for American calls because you can easily discount to the dividend payment date, whereas with the Black-Scholes, it is not as easy to do so. And also with dividends, there are 2 methods that we will be looking at. One is with respect to a discrete dividend payment. The second method is when you use a dividend yield. So we've looked at this example last week using a discrete dividend payment. We also looked at using a discrete dividend payment in the binomial model. Now, discrete dividend payment in this context means that you would know when the dividend is going to be paid, exactly when it's going to be paid, and you also know exactly how much is going to be paid. Okay, so you know the timing and the value beforehand, and you know it with certainty. Okay, so with that you can use the discrete dividend payment method. And so we'll just recap what we did last week. So with all the parameters for the 5 factors that we discussed in week 2, and given that dividend is 10 cents, XDIV is 5 days time, so there are 2 time periods, right? One is for the expiration of the option, the other one is the dividend payment. So you always discount the dividend payment to the present moment and adjust your stock price. So that's the same with both binomial and Black-Scholes that we looked at last week. And then you use the adjusted stock price in the calculation of your option, in this case a call. So again, that's the same thing that you did with binomial as well as with Black-Scholes. So having adjusted the stock price, you use the adjusted stock price into your call formula, right? So you first calculate your D1 using adjusted stock price, find the probability, compute your D2, find the probability, and you put it into your Black-Scholes formula. So essentially this is nothing but the expected stock price at expiration and the discounted expected value of the strike price at expiration, right? Now, the second method is when you use what is called a dividend yield. Now, with a stock, it's very simple, right? Because the stock will only pay one dividend or maybe even two dividends in a year, and you only have to take the dividend payment date. Now, with a basket of stocks such as an index, it is harder to do that, right? Because with a basket of stocks, there are so many stocks in an index. Some of them may pay more than one dividend, some of them may pay only one dividend, but in any case, they will all pay different amounts of dividend, and they will all be paid at different points in time throughout the year, right? So if you were to account, well, technically you can still account for it using the discrete dividend method, but that's going to be very cumbersome because imagine if you have S&P 500, you've got 500 stocks. If every one of them pays at least one dividend, you've got 500 dividend payments to account for, right? So you use what is called a dividend yield. Now, depending on where you go for your information, right? Some will publish the dividend yield for you, so you could use it easily. Some sources will not give you the dividend yield; they will give you what is called an accumulation index and a price index. Okay, accumulation index essentially is your total return. So total returns means, what is total return? What do you understand by total return? So if you invest in equity, what kind of return do you expect to receive? How about you? So the price is in capital gain, right? So you would, when you invest in equity, you hope for capital gain, you also hope for income stream, right? Which is your dividend. So some people choose stocks based on high dividend yield because they want to hold it for long term and they want to derive an investment stream. Well, some people speculate in the market because they're not interested in dividend, they only want a quick capital gain, right? So the accumulation index measures total return. And if you take the accumulation index minus the price index, that essentially gives you your dividend yield, okay? So remember, dividend yield is an annual number, just like your interest rates and your volatility number. So you have always to remember to account for the right time period given the option expiration, okay? Because your option expires, assuming you take 1 year's period, you have quarterly options, you have monthly options. So depending on which options you choose, you have to make sure that you account for the correct time period because dividend yield is for the entire year, okay? Now dividend yield, given that it's for the entire year, it means that there's an assumption here that dividend is paid continuously or accrue evenly over the entire year. Okay, so you take all the stock's dividends, all the payments at different points in time, and summarize into a dividend yield, assuming that it accrues evenly over the entire year. Okay. So the rest of the steps are pretty simple. You just adjust the stock price, or in this case, an index price, with the dividend yield. So the formula is given here. This D here indicates your dividend yield. Okay. So just very quickly show you how to use each of these. So you notice that the Black-Scholes model here has got only European options, right? That's in line with one of the assumptions in your Black-Scholes model, right? One of the assumptions says that the model assumes no dividend, remember? Okay? So the binomial model, however, has got both European and American. So if you were to change any of these parameters, as we've seen in previous weeks, all the numbers here will change, right? The Black-Scholes also calculates for you all your Greeks and your D1, ND1, and so on and so forth. Now, to account for dividend, a discrete dividend, all you have to do is key in the dividend here. So let's say I put $1, and time to expiration is, let's say, time to ex-div is, let's say, 8 divided by 365. So it calculates the present value. If I hit run, all the numbers would change, right? So effectively, even with a basket of stocks, you can key in all the individual dividends here, but it becomes very troublesome, right? So what you want to do is you simply use a dividend yield here. So let's say it's 5%. So you just key in 5%, and all the numbers will change, okay? Now you notice also that there's a difference in the value between your European and American call, okay? So that leads us to what is called the Black's approximation. Now, if you use the app that I told you about, you will also be able to see all the dividends as well. And in fact, that is probably more interesting because you have the slider, right? How many of you have tried it? Okay, so you can, it's like a ruler at the bottom, right? If you slide it, you can see immediately what's the impact on your option prices, and it also gives you a graphical depiction of the prices. Now, with Black-Scholes model, you find that it's harder to value an American call or American options. Okay, it's not quite suited for it. In fact, if you look at your Black-Scholes assumption, it is also for European options only, right? Now, why is it harder for Black-Scholes to value American options as compared to binomial? What do you think? Yes, so with American options you can exercise early, right? So you need to know what is the value if you were to exercise early so that you can determine the value of your American call, because we recall that we said the value of an American call is the greater of your intrinsic value if you were to exercise all the discounted expected value if you were to hold it to expiration, right? So you have to compare two values. So with the binomial model, it's very simple to do that, because you always start from expiration, right? And then you can discount to whichever period the dividend payment date is, and therefore you can compare the two values. Now with the Black-Scholes model, at which time period is the value of the call that you calculated? So you have your Black-Scholes model here. So you have a value here. What is this value at which point in time? Is this at the dividend payment date? Because we accounted for dividend, right? Is this the dividend payment date or is this the expiration date? What do some of you think? What do you think, sir? Expiration date. What do you think is expiration date? Well, you're correct, but I just want to make sure that you... Time T is expiration. Sorry? Time T. Okay, so what is D1, what is ND1? That is the probability at expiration, right? We use time to expiration, right, as well as D2. So the value of the call calculated using your Black-Scholes model is actually the value of your call at expiration date and not at dividend payment date. Okay, so as a result of that, you find that the Black-Scholes model is not so suitable to value an American call, so therefore we have what is called the Black's approximation. Now with the Black's approximation, you assume that an American call is essentially a portfolio of European calls, and you would then value the portfolio of European calls and take the greater value as your American call. So the steps are as follows. So you reduce the stock price by the present value of the dividend, as we have been doing all this while, and then you calculate the value of a standard European call with the expiration date as your time. Okay, so that's one European call. Now, you then calculate a second European call with the exercise price reduced by the dividend amount, and this time you take or you pretend that the expiration date is now the ex-date date or dividend payment date. Okay? So in doing so, you basically have calculated the value of two calls, right? And then you can compare the two and take the greater of the two. Now, why do you think we would deduct the strike price with the dividend amount? What do you think, man? Yeah, the one in white. Give it a go. Doesn't matter. Why do you think we want to reduce the dividend payment from the strike price? Do you want to say something? Sorry? No, why do you want to deduct the dividend payment from the strike price in calculating the second call? Okay, I think you know the answer. Okay, you just got to think a little bit harder. You'll be surprised at how much you know. What do you think, sir? It's quite simple. Okay, I'll give you a clue. Now, think about it this way. When you exercise, you pay out the strike price, right? You also receive your dividend, right? So why do you think you reduce the strike price with the dividend amount? Well, essentially, in doing so, what it means is that you reduce the liability of the strike price, right? So if I exercise now, I'm going to pay out strike price, let's say $100, but I'm going to receive dividend $10 as well, right? So effectively, the net to me is only $90, right? My outlay, right? So as a result of that, you adjust your strike price with the dividend payment. If you see something, and if you hear something, which one would you remember better? See something. You see something. So when you hear something, you forget. Which is why I want to illustrate to you, because I think the same way. If I see something, I remember better. If I merely listen to it or hear somebody say, I'll just forget. What if you feel something or experience something? Would you remember even better? You would, right? So therefore you need to practice, right? And you need to learn how to trade, because in doing so, you will learn to develop a feel for it. Okay, so essentially this is what it is. Now, so let's say this is time t, this is your expiration, and let's say this is your dividend payment. Okay? So under the Black's approach, now the Black-Scholes can't tell you what is the value of your call here, right? Because it uses the time to expiration. Okay, so under the Black's approximation, what you do is you value a call up to expiration, okay, using the adjusted stock price. Now, let's say we call this call 1, and then you assume that there's another call, let's say we call this call 2, for which the expiration is now the dividend payment date, okay? And then you adjust using the adjusted strike price. So now you have two calls, right? Effectively, you only have one call, which is call 1, right? But you want to value this as if it's an American call. So therefore, you pretend that there's another call here for which you would value up to expiration date. So essentially, under the Black's approximation, an American call is nothing but a portfolio of European calls. Okay? Now, if C1 is greater than C2, what does that mean? You you will not exercise the American call. Okay? So you can infer from that either the dividend payment is too small to make a difference, or the time value is large. Right? Right? Because with the American call, we value up to this point in time. With the original call, we value up to this point in time. So there is still time value to go, right? Okay? Good, you're speaking up. When you compare the two calls, your American call therefore becomes the greater of your call 1 or call 2. Okay? Now, if there are many dividend payment dates, then you have more than 2 calls to value, right? Okay, then it becomes C3, C4, and so on and so forth. So that's why it becomes a portfolio of European calls. Okay? Any question? Okay, and so let's just summarize. So again, you have your timeline, and same thing, T, dividend, and T. So what do you use for your underlying here? You always use your adjusted stock price, right? Okay, so this is your adjusted stock price, which is simply your S minus present value of dividend. What about interest rate? Would it change? It won't change, right? Very good. What about volatility? Would it change? No, right? Very good. What about strike price? So you use the adjusted strike price, right? Which is your X minus D. And what about here? At expiration, use your strike price, right? What about time? Remember, there are 2 time periods, right? You have always to remember that. So this must be dividend payment minus T. This must be your expiration minus T. Okay? Any question? You see? Okay, while we're at dividend, I'd like to share with you a strategy that people use in the market to capture dividend. So as the name suggests, the strategy allows you to capture the dividend by exploiting smaller option traders or inexperienced or unsophisticated option traders who omitted exercising their call when they are in the money. Okay, so the strategy is this. Now, if you want to exploit somebody who didn't exercise their call and therefore not earn a dividend, would you then, so you must take 2 positions, right? So let's say you're using a call, you would then long one call and short the other call. Okay, so which call do you think you would go long on? Or which call do you think you go short on? So let's say stock price is $40, dividend is $2. So you will short 1 call, you will long 1 call, right? Because then the difference in the 2 strike price would then allow you to arbitrage on it. So let's say this is for ease of calculation, let's just say 30. Now, why would you short the call with a higher strike price and long the one with a lower strike price? Now, remember, both calls have to be deep in the money, okay? So as to ensure that they can be exercised, okay? So both calls have to be deep in the money. This is deep in the money, right? Stock price at 40, strike price at 25 and 30. So you will short the one that is deep in the money and long the one that is even deeper in the money. Why do you do that? Can you do it the other way around? You know the answer. Too early. What do you think, sir? Why do you think you would want to short, or rather, why do you think you want to long a call that is deeper in the money than the one you short?
You can get profit from your share with higher price and buy with lower price?
Not so, well, that is true, but that's not the real reason, because as you will see later on, that simply contributes to the difference in which you would, to allow for you to break even. But there's a more important reason, which you fall back on lecture 1, you should be able to answer the question. It has to do with rights and obligations, right? Because you long one, you short one, right? So one of them has an obligation, the other one has a right. So given the rights and obligation of the two options, why do you think you want to long a deeper in the money than the one you short? How about you, sir? What about you? Okay, I'll help you along. Which ones would be profitable first? The long call or the short call? Long call will be profitable first, right? Okay? So if you have the right and you also have the obligation to pay somebody else, do you want to be profitable first, or you want the other person to be profitable first? You obviously want yourself to be profitable first, right? Because if the other guy is profitable first, you're going to have to meet your obligation and you're not even sure whether you're going to be profitable or not. Right? So if you are going to be profitable first, then it's okay to meet the other obligation, because by the time you pay the other person, you already receive your profit. Does that make sense? Okay? Excuse me. Okay, so let's see what happens when the other party don't exercise. So this is you, right? You long one call, you short one call. So if you long one call, you can exercise, right? Now, does it matter what the stock price is? Does it matter? Yes or no? So currently it's 40. Does it matter what the stock price is? Well, the stock price has to be greater than X in order to exercise, right? But does it matter what S is? Whether it's 40 or 50 or 100, does it matter? It does not matter, right? Because S will be the same for both calls, right? So let's just call it S. Okay, so S minus 30, right? Plus 1 because you received the dividend, right? Now, if the other person didn't receive the dividend, then it will be simply S minus 35, right? And this has to be a negative because you went short, right? So what is the result here? This cancels this, right? So you have 5 plus 1. Now what is the difference here? Equals to 5, right? So this is a cash outlay or cash inlay, the $5 here. Do you pay out the $5 or do you receive? Receive. Ah? Okay, what is the call here? $5, right? S minus X. What is the call here? $10, right? You long the call, so you pay $10. You receive $5, right? So this is a negative 5, right? Capital outlay. Okay? So what happens here? You receive 5 plus the dividend, right? In fact, the dividend doesn't even matter, okay? Whatever it is, you receive the dividend. So you find that you're better off, you actually did capture the dividend, okay? Now, if this guy also exercised, suppose you're wrong, because the strategy calls for the other guy to not exercise, right? So therefore you can capture your dividend. Now if the other guy turns out that he's more sophisticated than you think and he exercises it, what happens? Well, he would still have S minus 35 plus dividend then, right? So compared to what you have, which is S minus 30 plus dividend, then this cancels each other. You still end up with $5, right? Yes or no? So $5 and what you paid for, they're the same, so it's a wash, right? So regardless of whether you're right or wrong, you're not going to lose money, but you're going to be able to capture the dividend if you are correct. Okay? Any question? So this is an example of arbitrage. So remember I told you that in this course, you always want to know how to arbitrage. Whether or not there's an arbitrage opportunity, and if there is, how can you arbitrage on that, right? And you also always want to know how to hedge. Now, so next we move on to okay, so this is there are two more slides are included to facilitate your revision. We know that American coal is not as suitable to using the Black-Scholes model. Now I want to draw your attention also to this part here that the Black-Scholes model also does not work for American puts, not just American calls. Now why do you think it's even worse for American puts? Well, with an American call, you know when you want to exercise, right? And that's when the stock pays a large dividend and you exercise it just before the dividend payment, right? So you have a date that you can work on. Now with American put, when would you want to exercise an American put? So if an American put is very deep in the money, you want to exercise, right? Because waiting any longer is going to be disadvantageous to you because the price can move and you could be seeing a lesser amount if you exercise, right? But when is that going to happen? Do you know? What do you think, sir? Do you know? Or when does it happen? When the strike price, when the stock price is equal to what? When is it maximum for a put? What is the payoff for a put? What minus what? When the stock price gets close to 0, right? Do you know when that's going to happen? You don't know, right? Right? So if you don't know, then you don't have a date to work on, right? How can you value American put? You can't, right? Whereas American call you can because you know the date. Okay? Now, the next slide here is to emphasize to you that American coal under the Black approximation is simply a portfolio of European coals. So if the stock pays more than one dividend, then you have to value all the dividend, right? You have to value, you have to pretend that you have so many European coals, including the original one, okay? And then you value each of them, and then you find the greater of them all. So last week we also talked about historical volatility, right? Now, we discussed how we can calculate historical volatility, okay? Why do you think we want to calculate historical volatility? Now, implied volatility is the volatility implied in the market. So if you use the app that I gave you, you can see what is implied volatility in the market, right? Now, even with the spreadsheet I show you, you can also determine what's the implied volatility. All you have to do is equate the option price to the market price, and the resultant volatility number is your implied volatility in the market. Okay? So if you know implied volatility in the market, why do you want to calculate historical volatility? What are you trying to achieve? Well, in order to find this pricing in the market, you need to have a benchmark, right? So if you think that historical volatility is this number, or rather if implied volatility is given as this number, you don't know whether that is correct or not, right? It is just what the market thinks. But if you calculate your historical volatility, given whatever method you think is most suitable, so in other words, that you're then drawing on your expertise and experience and research to say that, oh no, the volatility in the market should be what I calculated and not the implied volatility that is shown in the market. So in doing so, you can therefore come to a decision that the prices in the market or the volatility in the market is incorrect and that you are correct. So therefore, you want to be able to take a position. Okay. So this is how it works. So again, you have a time frame here. So this is your historical volatility, right? You go back in time and you calculate what is the volatility. It's historical because you're going back in time, right? So then you determine what this volatility number is. And this is your implied volatility in the market, which you can determine, okay? And then you compare these two, okay? So if your historical volatility is, let's say, greater than implied volatility, what does this imply to you? What does that mean? So you think that the implied volatility in the market is too low in this case, right? So what can you do? So this suggests to you that there's a mispricing, but what are you going to do about it? You want to give it a go? Well, when you compare two numbers, the basic conclusion you draw is that the market is over or underpriced, right? And if it's over or underpriced, then you want to be able to take a position. So if you now think that the market is underpriced, right? Because you think volatility should be greater than what is in the market, what are you going to do? If it's underpriced, it means what? It's cheap, right? So what do? You're long the option, right? You long the call, and to hedge your position in option, what do you do with your stock? You long or short your stock? You short the stock, right? Very good. So therefore, with that, you have a basis to make a trade, right? So you long the option, you short the stock. So you long option, short stock. Now, if stock goes up by $1, what happens? You're going to lose $1 on your stock, right? But you're going to make money on your call, right? Now, if it's not over or underpriced, then this is going to be, what you make here and what you lose here is going to be the same, right? Which leads us to delta hedge. Now, if this is underpriced, then you're going to be earning more than what you lose on your stock, right? Okay? What if this is overpriced? So now you short call and you long stock instead, right? So again, if the stock price goes up, you're going to make money here, you're going to lose money here, right? Again, if it's fairly valued, it's going to be the same. But if it's now overpriced and you short the call, would you still make money? Yes or no? Is it hard to tell? If you have difficulty working that out, I'll draw you another example. Will you be able to make money regardless of whether it's over or underpriced? You must be able to, right? Okay, I'll prove that to you when we look at another example. Okay, so regardless of whether over or underpriced, you must be able to make more money. Okay? So why is it important to understand historical and implied volatility? Well, because for one thing, you can work out whether or not there's an arbitrage opportunity, right? Now, there are other reasons, other phenomena in the market that if you understand implied volatility, it will be easier for you to understand. The first one that we're going to look at is called the term structure of implied volatility. Now, the term structure of implied volatility describes the relation between implied volatility and time. Now, if you were to plot, let's say, implied volatility with time. So let's say you have two options here, okay? T and T. Now, what is implied volatility? Volatility of what? Of the option or of the stock? What do you think? Yeah. Of the stock, right? So if you have options of differing expiration date, would you expect implied volatility to be different? How about your neighbor? Either one. What do you think? So implied volatility is volatility of the underlying, right? The stock. Now, the stock doesn't have a time period, right? It goes on perpetually, but options do have expiration date. So if you're looking at two different options with differing expiration date, would you expect the implied volatility to be different? Have her out. What do you think?
I don't know. It's the same stock. I think for the implied volatility, it should be same.
Well, but you're given time, right? Different amounts of time, so the stock can move, right? Yeah. Now, if you're talking about the same amount of time, then it's not going to be any different, right? Same stock, same amount of time. But now you're talking about additional time. So additional time, the stock can move, right? Okay. So it's not hard to understand the term structure of implied volatility because, notwithstanding the fact that volatility refers to the underlying. Given more time, the stock can move up or down, right? So therefore, implied volatility can change, okay, over the time period. So if you were to plot this, and let's say you see an upward curve, what does that mean to you? Again, you notice that I'm leading you more towards interpretation of the theory and application, yeah? So what do you think it means to you? Does this mean that the stock is going up?
No.
Why not? You're getting the hang of it. Why not?
Just because a long period is also so fine.
Yeah, so the stock price goes up. Yesterday, not yesterday, last week we looked at two rates, right? When we look at the Brownian motion, right? So which one determines whether the stock is going up or down? The drift rate, right? So this is the volatility rate. The volatility doesn't determine whether the stock price goes up or goes down. it determines simply the volatility of the stock, right? So if it's upward sloping, it means that the stock is going to be very volatile, right? It can also be downward sloping. So what this suggests to you is that if you want to trade in the equity market, all you have to do is look at the options market, okay? Because the volatility would have been priced into the options market, and if you're not sure whether the stock is going to be volatile 1 week into the future, 1 month into the future, you simply have to look only at the options volatility, okay? Or rather the implied volatility in the options market. Now there's a second phenomenon which is called volatility smile or volatility skew. Now if you were to plot this, again implied volatility, how do you think it's going to look? Again, implied volatility refers to volatility of the stock, right? So now time is the same, okay? So only strike prices change. Would you expect implied volatility to change? What do you think? You want to help me? Think about it. Time is not the same, right? Volatility refers to volatility of the underlying. Now, strike price is the only variable that changes now. Okay? So you can be in the money, out of the money, and the money. Would you expect implied volatility for all these options to change simply by the change in the strike price? Yes or no? Okay, if you can answer the one on term structure, you must be able to answer this one too. What do you think? Well, this is harder to understand, right? Because look, if what determines the value of an option? Let's say a call. S versus X, right? Agree? Now, given time, this S here can change, right? So therefore, term structure of implied volatility is easy to understand. Now, given that time is the same, is S going to change? The same time period? No, right? It's the same, right? So therefore, there's no change in S. So if there's no change in S, then the implied volatility should not change across different strike prices, right? Right? Because implied volatility measures the volatility of the stock, right? So it should not change. However, if you were to plot different strike prices, right, you might find something like this. Okay? Or you might find a less pronounced one, or maybe a perfect smile, just like your smiley face. Okay? Or you may find something like this too. Okay? So this is called a volatility smile. This is called a volatility, this is called volatility smile, volatility skew, volatility smirk. Okay? Now, why do these things happen in the market? This moving across strike price, right? Well, the reason for that is that, you know, big out of the money options will start off cheap, right? Agreed? Who wants out of the money option? You are likely to be in the money and therefore you don't see your profit, right? So it's going to start off cheap. Now, however, if there is a net buying selling pressure leading to demand and supply imbalance, then you find that, well, if everybody starts buying deep out of the money option, then that's going to push up the price, right? Because there's demand, right? And as demand increases, the price goes up, so does implied volatility. Okay? Now, another reason could be that the true distribution of the asset prices has a fatter tail than what is assumed in your model, okay, in your pricing model. Now, quite commonly too is the fact that because deep out of money options tend to be less frequently traded, and therefore, if you were to go long or short on the deep out of money option, the clearinghouse or the exchange needs to set a price for it to be cleared, right? Otherwise, those become stale prices. So when the exchange or the clearinghouse steps in to set a settlement price, then that could be another reason contributing to the skew, or the smile, or the smirk. Okay? Is that clear to all, the difference between term structure and volatility smile? Okay, good. I see some of you nodding your head. So, okay, we'll look at one more slide before we take a break, if that's okay with you. Okay, so relationship between implied volatility and strike price is called the smile or the skew or the smirk if it is sloping downwards. Okay, as we discussed, it is puzzling because the volatility in fact refers to the underlying, and therefore it should not change. Okay. Now, we'll look at one more slide, which is on put option pricing. Now, you know your put call parity says that a put is equal to a call plus a bond minus your spot, right? So this is the first formula here. Now, you also know that the Black-Scholes formula for a call is equal to S ND1 minus present value of X ND2, right? So this first term here is your Black-Scholes formula for a call. Okay, you simply substitute this into your put call parity formula, so it becomes, so this term here, a call, becomes S ND1 minus present value of X ND2 minus X plus your bond. Okay? So with a little bit of algebra, you can summarize this into the formula for put under the Black-Scholes formula. Okay? So all you have to do is summarize the strike price, right? So this is the strike price. Okay? So this becomes 1 minus ND2, right? Yeah? Present value of X, present value of X, positive, negative, so 1 minus ND2, and again do the same with your stock. Positive, negative, so it becomes S1, okay? S times 1 is S, right? Minus ND1. Okay, so ND1, ND2, D1, D2 are determined in the same manner as the call. Is that clear to all the algebra, or you want to write it down? Are you good with that? Right? You simply rearrange the formula, right? Okay? Must be okay, right? All of you are very good in your maths. So, so there you have the put formula for your Black-Scholes. Okay. Now notice, however, that with your call is ND1, right? Now with your put, it becomes 1 minus ND1. Now it's also not difficult to appreciate that, because what it simply means is that if your call has, let's say, 80% of being in the money, then your put must have only 20%, right? Because they're on opposite sides. Okay? You alright? You good? Do you follow? Okay? Okay, good. So we take a short break from here. Okay, so next we look at the Greeks. Now, if you have understood the lecture 2, topic 2, is it topic 2? Yeah, lecture 2, on how all the parameters affect the value of an option, you would now find Greeks to be quite simple. Okay? The main thing is, again, you need to be able to link them. So first of all, you look at all the parameters that affect the value of an option. You understand how they're going to affect the value of an option, and then you move in. So having known that, then you want to know how sensitive is the value of an option to small changes in each of these factors, right? So once you know how sensitive an option is to each of these factors, then you can know which of these Greeks you want to hedge. Does that make sense? Okay? So it's very important that you are able to follow how one topic leads to another. So with the stock price, now is stock price going to affect the value of an option significantly or not? What do you think? So with stock price, we measure two things, right? We measure delta and we measure gamma. So if the stock price doesn't move by a lot, then we would hedge it using delta, okay? So delta is useful for small movement in the underlying stock price. However, if the stock price moves by a lot, then hedging delta itself is no longer sufficient. Then you want to hedge also what is called gamma. Now gamma, on the other hand, measures the change in the delta for the change in the stock. Okay, so there are two different measurements you want to take into account with respect to changes in the stock price. Now the next factor we look at is time, right? Now we also know that time has an impact on the value of an option. So with time, we want to hedge what is called theta. Okay, and then with interest rate, we will use rho, and what else am I missing out? Volatility, right? We want to use vega. Some people call it lambda, some people call it kappa, but we'll stick with vega. Is there anything else that I miss out? Okay, strike price. Do we need to hedge strike price or have a measurement for strike price? Yeah, do we want to hedge strike price? Well, we don't, right? Because the strike price is whatever it is. Once you choose the strike price, that stays with you, at least insofar as plain vanilla option is concerned, right? So if you look at all the factors there, once you choose an option, you have chosen the strike price, right? So that doesn't change, so long as you hold on to the option. But other factors change, right? The stock price can change, interest rates can change during the duration of the option, up to its expiration, volatility can change. So we need to be able to measure the changes in each of these, the changes in the value of an option given a change in each of these factors. Okay. However, strike price, we don't need to do that. Okay. So we know that as the stock price goes up, the call price goes up too, right? Now in the binomial model, you look at delta hedge using the hedge ratio as denoted by the small letter h. Now in the Black-Scholes model, we also look at delta hedge using ND1. Okay. Now ND1 can mean different things depending on how you use it. Okay. The same number for ND1 measures the rate of change, right? It measures the change in the call price given a change in a small change in the underlying stock price. Now, given that ND1 is also a probability, it must therefore be between 0 and 1, right? So as a result of that, you can infer therefore that the call delta must always be positive, right? Now, it also indicates to you what is the hedge ratio. So if ND1 is, let's say, 0.7, it means that you need to, for every call you go short, you need to long 0.7 stop. Okay, so it means different things depending on your usage. So at the limit, it reaches 1, right? As stock prices goes very high, ND1 reaches 1. If you recall what I just said to you, it also makes sense because why did it go up to 1? Well, because if stock price goes up to very high, then it simply means that your call is going to be deep in the money, right? Okay? Now we can graph the call against the stock price. So if you look at the chart I have for you here, and if you measure the tangent here or here or here, you find that it's going to be different, right? This is going to be much steeper as the stock price goes up. So this depicts the fact that if stock price goes up by a lot relative to X, the delta, which is the tangent here, is going to be bigger and bigger, right? Because this amount here is going to be bigger than this amount, it's going to be bigger than this amount, right? Does everyone follow? Okay? So therefore, at the limit, delta must approach 1, and otherwise, conversely, it will go down to 0. So by the same token, it means that as stock price goes up to very high, then your call becomes deep in the money, so therefore the probability is, of course, 100%, right, of being exercised. You can also graph delta against the strike price. So what I have here is that if you have a stock of 34, are both these sets of options in or out of the money? Is the first set in or out of the money? In or out? This is stock price 34, strike price 32. This is in or out of the money? I see some people saying out. Is this in or out? They're in the money, right? What about the second set? Well, they can be called this second set. This is at the money, right? Or near the money. Okay? So given that the delta for each of these poles is as shown here, you find that the difference here is smaller than the difference here. So what that suggests to you is that the delta changes most drastically when the call is at or near the money, okay, as depicted in the graph. So if this is the strike price, you find that when the call is at or near the money, this slope is much greater than when it's outside, right? The delta changes a lot when the call is at or near the money. So this suggests to you that if you were to do a delta hedge, you don't want to pick one that is at the money, because then you're going to have to keep on rebalancing your portfolio because it changes so quickly, right? So you're better off choosing one that is slightly away from being at the money if you were to do a delta hedge, because then you don't have to rebalance as much. Okay? You can also graph delta against time. So again, I have two sets of options here. Are they in or out of the money? The same stock price, 34 something. Is this in or out of the money? This one. You must know by now, right? So given the same stock price before, 34.65, is this set in or out of the money? This one? Out of the money, right? Now, you find that in the money options, as time increases to expiration, what happens to the delta? It's smaller, right? Now, as time gets closer to expiration, because this is less time than this, right? The delta is greater, okay? So this, as depicted on the graph here, if this is the amount of time, then you have to look at it from right to left, right? Because this is more time compared to this, if this is 0, right? This is always 0 here, right? So you have to look from right to left. So what it means is that in the money call, the delta for in the money call will quickly spike up to 1 when it gets close to expiration, and quickly drops to 0 when it gets close to expiration for out of the money call. Again, intuitively, you know that that is true, right? Because if the call is in the money and it's going to expire tomorrow, then there's hardly any chance that it will suddenly become out of money, right? So therefore, it must approach 1, okay? So next we look at gamma. Or maybe before that, I want to show you something else called a volatility arbitrage. Now remember I said earlier on in the first part of the lecture that if you calculate your volatility number, you will then know whether or not the market is under or overpriced, and therefore you can take a position, right? So suppose you, now this is what we're going to look at. So implied volatility here is given as buyer seller. You simply take the middle ground, so that's 17.78. Now, so this could be your semester break, right? You have studied option. I think by the time the semester break is here, you would have covered the entire option course already, right? So during your semester break, you're on a holiday, breakfast served in bed. Anybody has plans for that? On holiday during semester. Okay, anyway, you found that the implied volatility in the market is 17.78, and you basically have calculated your volatility number, and it comes out to be 35. So that's higher than what is in the market, right? So what that means is the market is underpriced, right? So if it's underpriced, what do? You simply do what? You simply long the call and you short delta number of stocks, right? In this case, it will be delta is 0.51. Now remember, 0.51 means several different things, right? It means the hedge ratio, it means the rate of change. So if the stock goes up by $1, your call is going to go up by 51 cents. And if you were to long a call, you will need to short 0.51 stock, and so on and so forth, right? It means a few things to you. So therefore, you long. So because the market is underpriced, you therefore long the call and you short 0.51 stocks. But because you can't buy half a stock, you have to always make it to round numbers. So it's 1,000 calls and 510 stocks. Any question up to now? Okay, the next day. Now, before the next day, are you confident that you're going to make money in the delta hedge? Yes or no? We have looked at delta hedge on a few occasions. Are you confident that you're going to make money? Of course you are, right? At least as far as theory is concerned, because in order for you not to lose money with a delta hedge, two things need to be correct, right? I mentioned that before. What are they? What are they? Can you remember? Now I mentioned that if you do a delta hedge correctly, you are not going to lose money, right? But two things have to be in place. One of them is that the direction of your trade has to be correct, right? So by direction, I mean if you long stock, you have to short call, and if it's a put, you will have to long put instead, right? So in getting the direction right, then the two instruments compensate each other, right? The second thing that you need to get it right is the hedge ratio. Right? Once you get the hedge ratio correct and the direction correct, then it compensates fully, and you will be assured of at least the risk-free rate. So you went to bed feeling confident that you're going to make money, right? So you long call short stock. However, the next day stock price falls by $1, and because delta is 0.51, when the stock falls by $1, you expect your call to fall by 51 cents, right? And if that be the case, then it's a wash if it's a fairly value. But because it's underpriced, you're going to make more money, right? So it turns out that the stock drops by $1, but the call didn't drop by 51 cents. It only dropped by 45 cents. Okay, so you made 510 from the stocks, but you didn't lose 510 on the option. Okay, so how does that work? Okay, it's quite simple. Now, let's say this is fair value for the option, okay? And this is a stock. Now, if the option is underpriced, as in our example, where is it going to be? On top or below? Top or below? Can someone shout out? If it's underpriced. Below, right? It must be here, right? This is fair value, is underpriced, right? So, did the stock go up or go down? The stock goes down, right? So the stock goes down by $1, okay? So you expect the option to go down 51 cents from fair value, right? However, you long the, now if you had bought the option here, you would have lost 51 cents, right? Yeah? But because you bought it here, you only lose this much, right? You follow? So it doesn't matter which way the stock moves, because now if the stock were to go up again by $1, then what it means is that the option is going to go up by 50 cents from fair value, right? Okay? But it's going to go up by this much. And you stand to make this amount here, right? So this is to illustrate to you that if an option is mispriced in the market, mathematically you must be able to make an arbitrage profit on it. Is that clear to you, ma'am? Yeah? Okay, next we look at gamma. Now again, with the Greeks, the formulas will be given to you, and you only need to be able to fit in the parameters, you get the resultant number, right? But more importantly, with the Greeks, what I want you to be able to do is to understand what they measure, which factors do they measure, and how these factors affect the value of an option, and therefore which Greeks do you want to use to hedge your portfolio, okay? So gamma measures the change in delta for change in stock given by this formula here. So if you, with all the parameters here, if you fit it into the formula, you get a core gamma of 0.01. Okay. So how do you use 0.01? What does that mean? That means that if the stock price goes up by $5, your delta is going to change by the original delta to 5 times 0.01. Okay. So the larger the gamma is, the more sensitive is the option to large stock price movement. So every time you look at hedging the Greeks, you need to determine whether or not the stock price is going to move by a lot. Okay, if it's going to move by very small magnitude, a delta is usually enough for you. But if it's going to move by a lot, you need to do your gamma hedge as well. So you can graph the same thing. Gamma against stock price, you find that it's greatest for at the money. Now, as we move on to all the other slides, before you look at them, I want to ask you a simple question. Would you expect most of these Greeks to change the most, or to be the most sensitive when an option is at the money or out of the money, or in the money, given your understanding so far? What do you think? You make a guess. Based on what you understand of how the parameters affect the value of an option, would you think that each of these Greeks, or most of these Greeks, would be more sensitive when an option is at or near at the money or out of the money, or deep in the money? You want to give it a go? In the money. Why do you think it is more sensitive in the money? You want to say something? What about you?
If the option is deep in the money, I will not talk a larger sensitivity.
Okay, in generally speaking, right, we're going to look at 4 5 Greeks, right? So the question is this: would you expect this to be most sensitive when the option is at the money, deep in the money, or deep out of the money? ABC. Multiple choice question. At the money. At the money. Why at the money? Well, because any small change is going to matter most when your option is at the money, right? Because when it's at the money, it can swing either way quite easily, right? If it's in or out of the money, then intuitively you know that it's not going to be so sensitive because it will require a bigger change for it to change for it to change, right? Okay, so as you will see in most of the slides that I'm going to show you, that fact will remain with you for the Greeks. Okay, you can match it against time. Again, you find that you will dip down very quickly. Also, I want you to notice this. With time, you will also know that, as we discussed, as it gets closer to expiration, again, what is going to happen? If you are deep in, you are likely to be deep in. If you are deep out, you're likely to be deep out, right? So it either plunge down quickly or plunge up or spike up quickly. Okay. So the same concept would apply across most of the Greeks. Now with exercise price, we say that there's no Greeks. However, I want to show you a slide, which is you may not be able to appreciate at this stage of the course, but hopefully next week you will. Now, when you do option strategy, you need to be able to choose the strike price, right? And when you choose the strike price, it's always a question of balancing the cost and your benefit. Okay, so for you to decide whether you want to take a position at this strike or the next strike, amongst other things that you want to consider is the cost, right? Whether it's going to be more expensive for you to go to the next strike or not. So here's a formula that you can use to measure the difference between the strike prices. Okay. So what it's saying here is that, well, if you have two different calls at different strike prices, now would you expect a call at strike 993 to be more expensive or less expensive than 969? More expensive or less expensive? Don't look at the slide, just based on what you know. What do you think? A lower strike call would be more or less expensive than a higher strike call? A lower strike call would be less expensive than a higher strike. So a higher strike call would be more or less expensive than a lower strike? Less expensive. So that's what you see on the slide, right? And how much more expensive would a lower strike call be? Well, it must not be more than what is calculated by this formula here. Okay? So this is a higher strike, a lower strike. You know that this is going to cost less than this. So if you want to buy this, how much more are you willing to pay if this is trading at 63 cents? Use this formula to calculate. You find that you won't want to pay more than 20 cents above this strike price. Okay? Okay, so next we look at rho. Now, rho measures change in the option price or change in the risk-free rate. Now, would you expect that the impact of interest rate to be large or small? You expect it to be small, right, as we discussed. And this is a formula you can use to calculate your rho. So if interest rate goes up by 0.5%, your call price is going to go up by
the rise in interest rate times what you calculated for your rho. Okay. As we discussed, interest rates impact is not going to be as huge, right? So is rho for call positive or negative? It's positive, right? Now, if this were a put, okay, let's say this is a put over here, do you still expect it to go up like this, or do you expect it to go down instead? What do you think? It won't spike, right? It will still be almost horizontal. But would you expect it to also trend up or trend down? You want to give it a go? Trend down. Why trend down? It's not always the other way around. Okay, I think we pointed that out before, but you want to be able to think through this again. Is interest rate good or bad for your call? Good. You still remember why it's good?
Because you can save money, you can put.
Okay, so for your put, good or bad?
Bad.
So what do you expect the line to be if this is a put?
So
Then it must be down, right?
Yeah.
Okay. So you can also draw that against the stock. Again, when you map it against stock, you always find that the sensitivity is highest when it's at the money. Now, Vega, as we know, is not directly observable. So this is the formula for your Vega. I'm missing one, right? We haven't looked at. Oh, we look at this. Okay, Vega. Is Vega going to be positive or negative? Positive or negative? Positive. Is call Vega going to be the same, larger or smaller than put Vega? What do you think? So Vega measures what? Measures volatility, right? Okay, measures the risk. Now with volatility, we talked about volatility is with respect to what? To the underlying, right? Not the option, right? So therefore, the Vega for a call and a put must be same or not same? Same, right? Okay? So here's an example for Vega. Again, input the numbers, you get 1.3. So what we're saying is that the call will change by 1.3%. Now, if you look at this number here, 1.3%, you notice that of all the Greeks that we talked about today, this change is the highest, right? So it tells you that Vega is one of the most, if not the most important Greek that you need to consider. Okay? Supporting Vega with stock, again you find sensitivity at the money is going to be the same with a put. If you plot theta, call versus time, again you find that as the option gets closer to expiration, it plunges down, right? Now, would you expect a put to have the same slope, same kind of curve? Yes? Yes, right? Okay, very good. So theta is given by this formula here. Again, with all the formulas, you just make sure that you put in the correct parameters. You should be fine. Okay, you can see that with theta, in the money, time decay is going to be faster. Okay, as we discussed in topic 2. Okay, a summary of delta H. You know your ND1 measures 3 things. Okay, probability, rate of change, your H ratio. So always get 2 things right: direction and your H ratio correct. This is another example on delta hedging that you can read. Okay, calculate D1, and D1 is your H ratio. So we talk about delta H requiring constant rebalancing, right? Because even if the stock price doesn't change, time continuously move on, right? So with the change in time, your delta is going to change as well. So therefore, you need to, if you want to do delta H, you must always be conscious of the dynamic hedging involved. Okay, so to hedge the delta for a portfolio, you simply add up the respective delta for the components in your portfolio, and this will be the delta that you're going to use to hedge. Okay, the hedge ratio. Is there any question on this slide? Okay, if not, we move on to another more interesting example. Okay, so I want you to pay close attention to this example. Again, the calculation is simple, but I want you to pay close attention because you need to know where the numbers come from. Okay, because this is a little bit more complicated compared to your delta H. Now, with delta H, you only use the underlying, right? You only use the stock. Now, when you hedge any other Greeks, okay, in addition to delta, if you were to hedge gamma, vega, or rho, or whatever Greek you hedge, you no longer can use just the stock. You have to use additional options. Okay, so this is a bit more complicated. So we're going to use 2 more options. We will call this option 1, and we call this option 2. Okay, so we have 2 more options here. One with a delta of 0.6. Okay, delta, gamma, vega. Another option with delta, vega, gamma as well. Okay, 2 more options in the market that you're going to need to use in order to hedge your gamma and vega. Now notice that we only show you 3 more Greeks here because you want to hedge gamma and vega, right? So therefore you need to know what is the gamma and vega for the options that you're going to use. However, we give you delta as well because once you take on another position, you will take on the delta as well. Okay? Now, you notice that whoever does this, short everything, right? Short call, short puts. So why do you think somebody wants to do something like this? Short call, short put. Is this person trying to speculate in the market, or is this person trying to do what? Or just writing options to earn the premium? Well, it's likely that this person is looking at earning the premium, right, from writing options. Now, if you want to earn premiums from writing options, then you must consider the risk involved, because in order for you to earn the premium, you now also have to assume the obligation, right? It's a compensation for you taking on the obligation. And because you now have the obligation, you should be even more concerned with the risk, because you're going to have to deliver, right? Whereas if you only have the right, you can just walk away, right? So therefore, you want to hedge all the major risks, right? And delta, gamma, vega is the major risk. Now, why don't you want to hedge interest rates? Why don't you want to hedge rho? Because for one thing, rho impact is likely to be small, and for the duration of the option that we're looking at, it's probably not going to change a lot, even if it changes, right? So why don't you want to hedge data? Why don't you want to hedge time? We saw a grid called data, right? What do you think is the reason for that? You see, you need to be able to think this through in order for you to decide which one you want to hedge, okay? What do you think you don't want to hedge data? Do you want to say something? Why do you think we don't want to hedge data? Do you need to hedge data in this case? Okay, think about this. Now, if I am a writer, well, what does data measure as time, right? So if I am a writer, do I want time to quickly go away in the sense that the option quickly expire, or do I want more time? I'm a writer. Do I want more time? The more time I have, the more I worry about my obligation, right? So I want time decay to go away quickly, right? So I don't want to hedge time, right? It works for me. If it disappears, it's even better for me, right? Okay, so how do we do this? Well, you first calculate your portfolio delta, gamma, and vega, okay, and then you will know how much of the position you need to hedge. And then using your portfolio gamma and vega, it tells you how many positions you need to hedge, right? And then you make use of these two traded options, gamma, vega, and delta, to determine your resultant position. So portfolio delta, now you can flip back to this slide to see the numbers. Okay, 1,500, this is a delta, this is a gamma, this is a vega. So all you have to do is take your position size times your delta, position times gamma times vega, sum them up. This is your portfolio delta, vega, gamma. Okay, any question? Okay, so to make it delta neutral, you then have to buy 450 stocks. Okay, because your delta is 450. Now, in order to make it portfolio gamma and vega neutral, you now have to use the other two options. Now, when you use the other two options, you're introducing new items into your portfolio, right? In doing so, you will also then be introducing the delta of these two options into your portfolio. Okay? So the solution is this. So you know that your portfolio gamma and vega is 6,000 and 4,000, right? Is it 6,000 and 4,000? Okay, it's 6,000 and 4,000. And let W1 be the weighting for the first traded options, W2 be the weighting for the second traded option. So you want to equate it to 0 so that you neutralize the gamma. So 6,000 is your portfolio gamma. The gamma for the first traded option is 1.5. The gamma for second traded option is 0.8. Okay, and this is your vega. Vega for first traded option, vega for second traded option. Equate that to 0, solve the simultaneous equation. You get W1, W2 to be 34.48 and 10.35. Any question? Okay, so you long 34.48 of the first traded option and 10.35 of the second traded option. In doing so, you have now introduced new delta into your portfolio. Okay, so because you have 3,448 new positions in the first option, 10.35 in the second option. Each of these options has their own respective delta. So therefore, you have introduced a delta of 25.86 into your new portfolio. You need to hedge that again, so you sell the equivalent number of shares. Okay. So the result. Any question up to this point in time? Is it clear where the numbers come from? Yes. Are you okay, ma'am? Okay, so this is your original portfolio, right? So this is your hedging. So you have 34.48 and 10.35 of the two options. Now, how does 2136 comes along? Now, 2136 is the net number of shares, right? Because what you did was you bought 450 shares to hedge your original portfolio, and then you sold 2,500 shares. Okay, so 2586 minus 450 gives you 2136. Okay. Any question? Okay, if not, that's all for today. So next week we will look at option strategies.